program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we want to briefly discuss an old options industry standby, the ODD, or Options Disclosure Document, also known as Characteristics and Risks of Standardized Options. The ODD is a comprehensive guide to listed options. All investors considering the use of listed options should get a copy from either their broker, one of the exchanges, or the OCC, the Options Clearing Corporation. Topics covered in the ODD include option terms, equity and index options, exercise and assignment, foreign currency and flex options, tax consideration and margin requirements, and of course, the risks for option buyers and sellers. From time to time, the industry will add a supplement to the original document, and about a dozen such supplements have been added since the mid-90s. Now remember, if you are thinking about using listed options, do get a copy of the Options Disclosure Document from your broker, an exchange, or the OCC. That's it for today's industry happenings.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Hello, everyone. Welcome to Profiles and Perspectives. I've got Jeromee Johnson and John Denza joining us from BATS today. Welcome, guys.
Thank you for having us.
Thank you. Happy to be here.
Thanks very much for taking the time. This is all about educating our listeners. Why don't we talk about, the formation of BATS, and why don't you talk a little bit about how BATS came to be?
Mm-hmm. And maybe you can start off and talk about BATS.
There's a firm called TradeBot that's based in Kansas City that Dave Cummings had founded. You saw the landscape at the time several years back where there was two predominant players in this space. It was New York Stock Exchange and NASDAQ. And he had concerns that with his business where his margins are extremely tight, that they would actually start raising the rates. They would charge their customers to trade on those venues. So he did some thinking and thought through the process and came up with the idea of actually creating more competition within the space to help, the smaller firms and so forth in the space.
But that was right at the time that New York and NASDAQ were going out and buying up Ready and Arca and INET and Island and all the ECNs were getting gobbled up, and there was the potential threat of a duopoly in the marketplace. It was important to make sure that competition stayed. As BATS grew and evolved, it went from being an ECN to a full-blown SRO and a regulated exchange here in the U.S. We started up over in London as an MTF there on the ground, and about a year and a half ago, entered into an agreement to acquire and successfully closed on Chi-X Europe. So at this point, we are now the largest pan-European equity trading venue by a good measure. Our market share over in Europe on a pan-European basis is 24-25%. So we're very excited about that. And then our most recent initiative, so just about 4 years ago, BATS decided that it made sense to continue to grow and expand and get into the derivatives markets. The most logical place for that to happen, given our presence in the cash equities markets, was U.S. equity options. A lot of the same things that were happening in the options market at that time and really now, a lot of the trends still continue, were things that BATS had lived through in the cash markets. So, you saw in the cash markets the rise of the ECNs and what was happening with algorithmic trading on the cash side and the emergence of high-frequency traders. And you saw, what happened with decimalization and the fragmentation of liquidity and all of those sorts of things. So things that, from a competitive landscape standpoint, that we thought we could fit in well and bring a level of technology and market structure focus to the options world. 4 years ago, BATS called me and said, what do you think about coming out to Kansas City and helping build and run an options exchange?
And where were you coming from, Jeromee?
So at the time, I had just wrapped up the sale of a company called 3D Markets. So my partner, Dave Mortimer, and I, for a couple years, had been focused on different side of a lot of the same trends, the crossing of institutional liquidity in the options markets. So I, with the completion of that sale, went from big and chunky and dark to small and lit and moving very fast. But a lot of all the regulatory trends, all the trends among the participants, everything else around that on the macro side very much stayed the same.
Now, John, how did you find your way to BATS?
I actually I started in the industry working for a company called Island ECN, which Jeromee had referenced before. In that firm, I was actually working on the trade desk, moved my way up through sales, and from there was part of the Island Internet merger, worked at Internet, and then from there moved on to NASDAQ. During this period, I had actually met Dave Cummings when he initially got his start, and I helped him with his connectivity into Island ECN. Always kept an open dialogue with Dave. And then it's funny, I actually went for an interview at Lehman, which is good. I didn't take the position. And at the time, they said, we made this great investment. Your background has been always focused in the exchange space. Would you like to, meet with Dave? And I said, of course. I've known Dave for quite some time. Had dinner the next week, and I've been here for 5.5 years.
Fantastic. Well, in the option space, as you said, Jeromee, you brought some real interesting technologies. How have the first 4 years been? You're meeting your goals, you're exceeding them. Where are you?
Mm-hmm. So certainly everybody wants more volume. Everybody wants more market share. So for the kind of the evolution of BATS in the options markets, I said when we started up, give us a year and we want to get to that kind of 3 to 5% range. It took us a year and a month before we crossed it the first time. Mm-hmm. So since then, there's definitely been an evolution and a change in our liquidity mix, where out the gate and really for most of that first year, it was almost 100% non-marketable customer flow that was posting on the exchange. If you look at our kind of more recent initiatives and you look at the mix of liquidity that we have on the exchange now, it is much broader, much deeper, where we have a very high level of market maker participation as well now. So certainly all liquidity is good liquidity, where we're not turning away any customer non-marketable stuff. That's a chunk of what we see on the exchange. But the breadth that we're able to provide in the marketplace is something that's either head and shoulders above where we were at a year ago or 2 years ago.
Excellent.
Maybe, Jeromee, you could touch on how the percentage increase of our quoted activity over the past couple of months especially.
Yeah, that's a great measure. Thank you. We have a program we abbreviate, call it QIP, a quoting incentive program, that is specifically targeted at market makers, where purely for being registered in a product on BATS, if you're registered in at least 20% of the associated series, I don't care which 20%, you pick and choose where you want to quote. For assuming those affirmative obligations, a market maker will receive anywhere from 5 cents to 8 cents additional rebates on their transactions on BATS. And it's a very happy conversation with many of the market makers out there. You think about how they interact on another venue, a competitor of ours, one of the other exchanges, and the costs of how that works. BATS, for the folks that don't know out there, as a price time make-take exchange, I pay folks for providing liquidity to the exchange.
So why don't you say that one more time? Because I think probably a lot of our listeners are not aware of the various models. So how does that work exactly?
Yeah. So for liquidity providers, somebody who has an order, who comes in and posts that order on the exchange, their reward for doing that, and the other side of that, the incentive that I'm putting out there to attract that order flow, is a payment. You come in and you add an order to my book and post it. Whether you are a customer, you're a market maker, you're a firm, doesn't matter. Adding liquidity to the book, you're going to get paid for that. On the other side, so somebody who is watching the market, who sees those orders out there, somebody who is taking advantage of that price formation, somebody who sees the liquidity and wants to interact with it, those removers of liquidity from the book, we charge on that side of the trade. And that's where, as an exchange, we make our profit in the middle. There's generally a little bit of a differential between what we charge and what we pay, although that's not always the case. Mm-hmm. Certainly for some of the most valuable order flow out there, if you look at the rates and the schedules, there are times that we pay more than what we charge, and the rates are what they are. That's part of the wonderful competitive environment that we live in. We're excited about that.
And it continues to get more competitive. We're now, I guess, up to 11 exchanges with a 12th coming on board, I guess, in the next couple months. Mm-hmm. Many of our listeners, they look at their screen and they see a bid offer spread, and I think many don't realize where they get the executions, where they get them done. Mm-hmm. Do you think, certainly the volumes for the most part have continued to grow. The last 4 years been a little bit flat, but, at very high levels. Transparency, access to the markets for the retail investor, never better. Do you see a bullish outlook for the industry? Do you think, these additional exchanges, Jeromee, you were talking about your model. There are lots of different models out there. Is all of this benefiting the retail investor?
I would think that what it really comes down to is education. It's going out there and having people understand how to trade options. I think that there's tremendous potential from especially abroad coming into the States, and also educating the asset managers and on the buy side how to trade options and how to include that as part of their portfolio.
There's a trade, right? So what are the negatives to the level of competition that you're seeing in the market, right? So whether it's another exchange coming on in a couple months, or we go from 10 to 11 to 12 to 13 to 15 exchanges, or whatever it is. And you said for the retail guys out there, they look and they see two sides of the market, and that's what the spread is, and they click their button, and for the most part, hopefully, things work well. They don't have to worry about it. Right. Times have never been better to be a retail investor in the market, and I think we should feel very, very good about the direction of the market and the benefits of that competition. It's a little bit different for some of the brokers, for some of the institutions, because the trade-offs, you take that liquidity, and that liquidity becomes fragmented and spread across multiple different venues. And so the complexity of accessing all of that liquidity is a challenge for the brokers. And so, I don't want to minimize, certainly, when we whether it's with the Exchange X, Exchange Y, Exchange Z, for the folks coming to the market, that there is no cost to it. But certainly, for the retail community, for the active options traders out there, for the guys that they've got their account at their broker and they decide that they want to juice their return a little bit or add a little protection to their account, whether it's the cost of the trade, the efficiency of the execution, the tightness of the spread. 10 times for folks at that end of the spectrum have never been better.
Really excellently, beautifully clear explanation of that. Really well put. I think it is a great time for the retail investor. Earlier, you talked about Europe and some of the things you're doing over there. Can you tell us a little bit, some of the differences, the key differences you see between, the European community and how business is done here in the U.S.?
So first, from a regulatory standpoint, we talked about some of the parallels. We talked about some of the differences as well. How we got started over in Europe, to toss out an abbreviation, MTF, right? So, multilateral trading facility. The broader European landscape has gone through, again, some of the same changes or very similar changes of what we went through here in the U.S. a number of years ago. So if you look at things like regulation in MS and how the venues interact and compete here in the U.S., similar regulatory changes in the European landscape, MiFID, have opened up competition with the traditional exchanges over in Europe. So it used to be, I'm going to rewind half a dozen years, it used to be that if you wanted to trade French securities, you could only trade those French securities in France on the exchange that was headquartered in Paris. If you wanted to trade German securities, there happened to be two in Germany, and you had the Deutsche Börse, and you had the Xetra, which was their electronic piece there. If you wanted to trade UK securities, you could only do it in London. MiFID really opened the doors and allowed those exchanges and their competitors to trade on a pan-European basis. So there's the ability for somebody like a BATS and certainly other competitors, and things have changed in that landscape as well, where those exchanges now compete much more head-to-head. We got on the ground there very early. Chi-X was, who I made reference to earlier, we acquired a year and a half ago, was really the first mover over there to establish kind of a pan-European MTF. So the wonderful, the competitive landscape on the cash equity trading side there. Today, we are changing that a little bit, where rather than being an MTF, we're going through a similar process, what we went through here in the U.S., where we went from being an ECN to a full-blown SRO or an exchange where we have a certain regulatory status. We're going through what's called an RIE, Registered Investment Exchange application process over there in Europe, where we will be able to do some of the same things, again, that we do here in the States when it comes to listing companies or listing, more realistically, exchange-traded products or ETFs and things like that. And we'll have the same sort of regulatory status as the London Stock Exchange or Euronext or Deutsche Börse or the other big exchanges there.
And from a customer standpoint, are your customers in Europe similar to your customers here in the U.S.?
So a lot of the customers, a lot of the trading that happens around the globe, not just in the U.S. and Europe, certainly Asia as well. A lot of the customers are very, very global in nature. So you think about whether it's the global investment banks or the asset managers. When you think of you put your money in your mutual fund and it's at a Fidelity or a Janus or a Wellington or whatever, a lot of those funds trade at a global level. The brokers that service them operate at a global level. The broader European landscape, though, I would say is not necessarily quite at the same level of technology sophistication. There are other frictional costs that we're happy to follow that BATS tagline, making markets better. You look at the European landscape and the costs of things like clearing. I'm happy to say that we're a leader when it comes to putting in place competition on the clearing front and what's happening on that landscape over in Europe as well.
Very good. John, any thoughts there? No? Okay.
I think that Jeromee summed it up perfectly.
All right. One of the latest products here in the U.S. are these mini options. I see you're offering free mini option trades on the exchange. What's the thought there?
I think, with the introduction of a new product and with the way that the cost basis is on the product, I think that we thought it was smart to come to market with a pricing that actually suited the product, which was going for free.
Okay.
Yeah, minis are exciting, right? So you think about the retail community and how many folks out there can actually afford to have 100 shares of Google or 100 shares of Apple in their PA or in their accounts, and that population that's trading those very, very high price securities in round lots and in groups of 100 shares is pretty limited because those securities are so high priced.
Right.
And so taking a product and tailoring it to what's the appropriate size for folks who have those sorts of positions, and can we more effectively let them trade options, that hopefully brings to the table a new class of investors out there who haven't been able to efficiently trade options. So that's what the minis mean for that retail community. Now, around that, though, we talk about the brokers and the exchanges and stuff like that. What are some of the other complexities and the other frictional costs of doing those transactions? The clearing cost in trading a mini isn't different than the clearing costs associated with trading a regular option contract, or the ORF fees, the options regulatory fees that are associated with trading a mini aren't any different than the regulatory fees associated with trading a regular option contract. So from an exchange standpoint, as JD noted, us removing a little bit of that, it didn't cost us anything to come up with the minis. We're not out there as those brokers marketing it to the retail community. Now, you're going to give a little back and see if we can do our part to help these things succeed. From our standpoint as an exchange, we don't need to take a piece of that. Let's just give them away for free.
Fantastic. I mean, part of the way I think the industry's continued to grow over the last few years, is the advent of the new products. I mean, the weeklies. I mean, it's remarkable the volume that the weeklies now seem
Absolutely.
to be generating. We just heard today, 19%, last month, with expectations of 25 to 30 going forward by the end of the year. Well, let's see. Are there any other initiatives before we wrap up that you want to talk about?
Yeah, that's an exciting thing. So to the extent that we have any listeners on the brokerage community or folks who tend to have a little bit higher sort of throughput requirements, we just quote unquote open the floodgates. Maybe that's a good way to phrase it. One of the restrictions that we had historically put on folks who quote in bulk on bats, so folks who in a single message would put order prices associated with as many as a couple hundred series with one order. Using our bulk quoting interface, that was limited to 5,000 orders per second. Now again, this is 5,000 orders per second. That was limited. Yes. We were limited to 5,000 orders per second. And again, for the retail guy sitting at home, you can't push your button that fast to get 5,000 orders per second into the market. But for the guys who are automated, for the market maker community out there, the guys on the brokerage side, that was a limit that we had in place that would require them to take potentially mini ports where they would have tens of dozens of ports, depending on what their interaction requirements were on bats. In lifting that restriction for folks who are using that bulk interface, that will let them be more efficient with regards to how they interact with the market. They won't have to scale that order flow quite as horizontally. So fun stuff certainly on the technology side. And always looking forward, for the next new product to come online as well.
Well, fun stuff indeed, and the technology is just really remarkable. Jeromee, John, thanks very much for joining us today, and I hope our listeners have really gotten a good background and education on the BATS exchange. Thanks, guys.
Thank you. Happy to be here.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Steve Claussen of OptionsHouse. Steve, thanks so much for joining us. How are you doing today?
It's great to be here.
Now, I know you're a guy who's been around the industry for quite some time. Tell me a little bit about your background.
Calling me old, aren't you, Joe? I'm going on my 30th year in the industry. As I look up at the calendar and realize I started in '83 on the CBOE, as a runner, essentially, like many people started back then, and worked my way up to be a market maker in the index products. My specialty was when the CBOE reintroduced the SPX product and the OEX product, and was trading on the floor during the crash of 1987, which are still some of the most exciting days of my life. Not necessarily the happiest days or the best days, but certainly I've done a lot in the industry, and the industry's been great, and it's been a great ride so far, and it continues to be that every day.
Yeah, wow. So you were in the OEX pit for the crash of '87?
Yeah, that was really something. When something like that had not happened since options have been around, certainly. And I remember my instructions. I was working for a firm called O'Connor and Associates at the time, which was a large market making firm, and my goal down there was to make every single market and try not to do any trades at all, because we wanted to make sure there was liquidity for customers, but everyone's positions, because the market had moved such a dramatic amount, everyone's capital position was pretty much unknown. So it was like, provide liquidity, but try not to bring home any positions.
Yeah, I was on the floor myself, and certainly not in the OEX pit, but yeah, they were grave days for those of us trying to survive that debacle.
Absolutely. Since then, I've used that experience and worked for banks internationally, running options trading desks in Tokyo and in London, and more recently, I joined a firm called Peak Six, who 6-7 years ago started an online options broker called OptionsHouse, and came over to OptionsHouse about 3.5 years ago.
Yeah, I'm sure many of our listeners are familiar with OptionsHouse. Tell me about what you're doing at OptionsHouse, and maybe what sets OptionsHouse apart from some of the other brokers out there.
Oh, great. I am what's called the chief investment strategist, because I've got at OptionsHouse, and because I've got trading experience. I deal with our customers and a lot of education, and teach different strategies, as well as explain risks associated with options. Options are great tools, as you know, and when used the right way, options can really round out an investor's portfolio. But options also sometimes be used incorrectly, in which case you have all risk and not a lot of reward, or not a lot of risk management. You're just assuming risk as risk transference vehicles. So at OptionsHouse, I am dealing a lot with our more active customers, and OptionsHouse itself as a company has really tried to partner with active traders. I mean, you showed me a chart that showed the explosive growth of options since since really 2005. I mean, it really started in 2000, but since 2005, 2006, options trading has really exploded, the volumes. And I think that that's due to, modestly I'll say, but due to companies like OptionsHouse, brokers like OptionsHouse, online discount brokers who have really leveled the playing field by both, bringing real-time quotes and super active, super easy chains to execute trades on, to really level the playing field for retail investors relative to professional investors. I mean, my entire life I've been a professional options trader, and when I look at the platform and the system that we provide for our active traders, or for all of our traders, it's amazing to think that you can be a dentist in Des Moines, Iowa, and have so much information at your fingertips and so much access to the markets in so few clicks. And at a commission, I remember the first time I traded an option was I was not on the floor yet, but I was down in Indianapolis through Lehman Brothers, and I think my first options trade I did one contract, and it cost $182. And
was that discounted?
And now, I mean, a retail investor, actually, their cost of commission and more importantly, the bid-ask spread cost is so narrow. I mean, it rivals any professional trader. In fact, a lot of times much cheaper than a institution or a professional trader.
Well, I hope our listeners agree. I mean, the access and the cost of getting into the options market in this day and age is really quite remarkable. In terms of, are there particular initiatives you're working on at Options House?
Well, what we really try to do is give a competitive edge to these active traders that we're really trying to partner with. And by doing that, we do it both in price. We have among the lowest commissions on the street. Definitely check us out. If you're not familiar with Options House, you'll be shocked and amazed, I trust. But the control that we give active traders, the ability to speed matters and speed of execution. People talk about how quick their pipes are, but probably more importantly is, I think, the speed that is required when you have the thought to do a trade, to buy stock, to buy an option, to buy an option spread. To how quickly that thought can be put into the market, into the marketplace, is critically important. How many clicks does it take? How quickly can you research an idea and execute that idea? And that's the control that we really have continually worked for. We know retail investors are not sitting in front of their screens necessarily all day long, 24/7, like an options maniac like you and I would. So a newer initiative that we're working on now is to really enhance alerts for customers. I mean, besides the basic alerts that customers ask for, trade alerts and price alerts and things like that, we're evolving and designing alerting functionality that is maybe on a different level. Alerts on profitability of a trade, or alerts on risk profiles changing. One of the things that most online brokers, Options House included, does is they have a suite of risk tools that can really show top line risk to a retail investor. For someone that has a more complicated portfolio, many more positions, many more symbols, and so we're working on putting that same risk control and that same risk monitoring and system, but putting it with an alert package that will tell people when they're away from their computer, that something has changed in their portfolio that maybe requires their attention and action.
Well, I know you've had some success with that initiative and others over at Options House. Continued success, and how about if we roll into the strategy spotlight segment of our interview here? You decided to talk about LEAPS strategies. When I reached out to you, and we talked about, hey, what do you want to talk about? So before we maybe get into a couple LEAP strategies, why don't we start by making sure all of our listeners are sure exactly what a LEAP is? You want to start by defining exactly what a LEAP option is?
Yeah, I think LEAPS. I'm excited we're talking about LEAPS, and quite frankly, I had to actually look up the official definition because I knew you'd be asking that. Because LEAPS are basically, to me, LEAPS are just long-dated options. Options have expiration dates. They're a wasting asset. That's one of the considerations that a stock trader really has to get their head around when it comes to transitioning to using options, that it has an expiration date. Stock, of course, doesn't have an expiration date. So the official definition, or LEAP, is an acronym for long-term equity anticipation securities, and they pull out LEAPS in there somehow. And
what are we anticipating?
They gave them the name LEAPS, and they're anticipating, so I think that, they're anticipating a long-term move in the underlying, either a long-term hedging for the underlying or a long-term, positive move in the underlying. The anticipation thing, that's the part that I got to quite frankly admit that, they're long-term options. So the anticipation is, when you put on an options trade, you do typically have a view. You have a bullish view, a bearish view, maybe a neutral view, and four views, and maybe a volatile view. And so what these LEAP options allow you to do is express that view, but rather than over the short term, over a much longer term horizon. So you have a longer amount of time for your anticipation or your view to come to fruition.
I'm with you. Long-dated options, that's how I define a LEAP. And the whole anticipation part, well, that's part of the acronym. But before we get into the strategies themselves, let's be sure again that our listeners are familiar with, how many LEAPs are out there. I mean, do all the underlyings, and I think at this point there are about, somewhere between 3,700 and 4,000 products, different underlyings that have options on the various exchanges. What percentage of those underlyings have LEAPs? They all have LEAPs?
No, they don't actually, but probably about 25%, maybe even 30% do have LEAPs, and the number I think does vary and it does grow. Not every underlying, should have LEAPs. Not every underlying has the liquidity in it, the interest, and the liquidity comes from all market participants, obviously. But about 25%, maybe around 800 issues have LEAPs. But it's going to be the 800 issues that retail investors are most interested in. If you're interested in the issue, chances are it's going to have a LEAP, and then you can easily determine that. There are lists that are posted by the different exchanges. The CBOE.com obviously has one. But also just in the option chain that is on your OptionsHouse platform. Of course, if there's a LEAP option listed and it's a long-dated option, they are in January. That's something else we should tell your listeners. January 14, January 15. Those are the LEAPs, and if they're listed and open, they will be at the bottom of your chain.
Well, I think that you raised an important aspect, that liquidity in the underlying and then these various option markets is pretty good in order for the underlyings to have LEAPs. So, that can be an advantage also towards maybe participating in the LEAP product. Let's talk again a little bit about some of the risks associated with the LEAP before we get into the strategies themselves. Implied volatility is a critical aspect in the LEAP option. Do you want to speak to that, and maybe even speak to the implied volatility versus theta? That whole aspect of things. Speak to the risks, if you would.
Yes, whenever I talk to any customers, whether it be in webinar, live events, or any or individually, I always hammer home that if something looks too good to be true, obviously it probably is, and it's not true. And nothing is absolutely free in options. A lot of people say, oh, you can overwrite a call. It's free premium. Nothing comes free in options, right? There's risks associated with every option strategy, and there's benefits and rewards associated with strategies. And one of the things that is I'll start actually with the benefit of the LEAP, I think, especially when it comes to stock traders and how they look at options. I've seen many stock traders say, oh, I was bullish on this stock. I was going to buy the stock, but instead I wanted to try options, so I bought a out of the money call on the option, and it was expired in 2 weeks, and because I got these weeklies now, and sure enough, the stock went up, but it didn't go up far enough, so my option expired worthless. I hate options, right? Again, that's because of theta, what you described as theta, time, right? Option's a wasting asset, and a 2-week option every single day. Well, today is 1/14 of that option is gone. Tomorrow, 2/14 of the option is gone from today's perspective. The benefit or the challenge with short-time options or short-dated options is that theta, that time decay, it accelerates as you get closer to expiration. Well, now let's think about these LEAPs, long term, right? A year and a half. January of 2015 is a year and a half away from now. One day is a spit in the bucket, right? There's very little theta, very little time decay on these LEAP options each and every day, because a day is just, quite frankly, not that significant in terms of the total life of the option. Now, nothing comes free. That sounds great. So in that regard, these contracts act much more like stock. They have a weighting asset component, certainly, but it's over a much longer period of time, where stock has no wasting asset, right? It doesn't have an expiration date. So there's very little theta. That's a benefit. But what they do have is they have a much higher We define it as Vega. I've heard other people call it Tau. They have a much higher relationship or sensitivity to the implied volatility. So the implied volatility is a much larger component of that time premium, because implied volatility is time value or volatility value. Because you have so much more time, the exposure or the sensitivity to volatility and volatility moves is going to be much more dramatic. So that's something that if you're trading in these leaps, if you're long a number of leaps, if implied volatility shares lower, the value of those options and value of that extra time that you have in the leap product is definitely going to be harmed. Likewise, if volatility increases, it would benefit you.
So as you say, there is no free lunch. There's always a risk component. And just so all of our listeners are clear on what implied volatility actually is, it's the expected movement in the underlying going forward. It's the market's expectation for the underlying's movement going forward. And that's what this implied volatility or time premium is. And as Steve points out, that's where a lot of the risk is with LEAP options. Now, where can investors find LEAP implied levels, Steve?
On the OptionsHouse platform, they can find implied volatilities for each and every strike on the option chain itself. We have different formats on the chain. One of them is called Greeks, and we're talking about the Greeks here with implied volatility in Vega and Theta. And you can see the implied volatility right on the chain as you're evaluating and looking at the LEAP option premium as well. As well, other sites, I know your site actually has a volatility. Is it a volatility calculator, or it just shows the actual volatility of a symbol and its long-term option?
Yeah, we got a couple things, but probably the easiest thing for investors to look up are the implied volatility charts. And what they are is a 30-day composite of the call put over the course of 12 months. So you can get a very good sense of what the implied volatility in that underlying option has been over the past 12 months. And of course, that's at optionseducation.org.
That's a great tool to use, and I would definitely advise investors to look at that, because that implied volatility, as you described it, was the market's expectation of the potential move of this underlying, and that varies, right? And so sometimes it's high, sometimes it's low, and then you can take a look at that chart and see where it is now relative to where it's been. And while every ship at the bottom of the ocean had a chart in it, those charts can definitely help you gain some perspective of, is this implied volatility relatively high to where it's been, or relatively low, or relatively fair? And one of the other ways, and a more simple way that I think of and describe implied volatility, is that number itself is on an annual basis. It's an annual measure. So if you see something that has an implied volatility of 30, what the market is really saying is that's in percentage terms, but it's really saying the expectation of the market is that this stock could be up or down 30% over the course of a year. And I think that gives people some sort of, it's much more simple, much more basic, but some sort of measure of what exactly are they saying? Wow, they're saying this stock, could move, 30% over the course of the year. Do I think that's right? Do I think it's high? Do I think it's low?
Well, let's you got some favorite LEAP strategies that you like. Why don't you offer a couple for our listeners?
Because these LEAPs are so long dated, and because they are very similar in their characteristics to stock ownership, I really think that using these products as a replacement for stock, as a proxy for stock ownership, allows an investor to do a multitude of things. It allows them the leverage that's available in options. You control 100 shares by owning one contract, and options contracts, obviously call options, will cost less than the overall price of the stock. It allows you to diversify your investment capital across a multitude of symbols by spending less money up front. But in addition, by buying a call option, whenever you buy a call, your maximum risk is 100% of what you paid for that call. Just like when you buy a stock, if it goes to zero, your risk was 100% of what you paid for the stock. So inherent in using a cash replacement or a stock replacement strategy by buying long calls, the strike price is in effect your stop loss price. Below that level, you have the right but not the obligation to buy the stock. So by definition, if you buy a XYZ stock is trading 100, if you buy the 85 call in XYZ, below 85, of course you wouldn't exercise that right. So you would in effect have a dynamic stop loss down 15% in XYZ's price. So by using these LEAP options, you are, you're spending less money up front, less capital up front. Your maximum loss is 100% of what you pay. Your maximum gain is, relative. It's unlimited to the upside, just like owning stock would be. But you have that stop loss in place right away by, at the strike price that you choose to buy.
Okay, so stock or using LEAPS as a stock replacement, that makes an awful lot of sense. I hope our listeners got that. And do you like to acquire LEAPS and then trade an option? Do you do LEAP spreads at all, or do you just really prefer to use LEAPS as a stock substitute?
Well, what I as a non-stock substitute, a lot of people like using the covered call strategy. So what I'd like to do, in addition to just owning the LEAP option as a replacement for the stock, is I like to overwrite an option of some sort. And that could be in the same term, so you could have a LEAP call spread to lower that premium that you pay. Again, 100% of the premium that you pay is your total risk. So if you can lower that number, that will lowers risk. It also limits your potential reward. But more favorably is what I call a diagonal spread or a diagonal LEAP collar, or a covered call basically, and you cover what you're in essence doing is selling a 30-day call while owning a year-and-a-half call. Now, the reason you may consider doing that is the 30-day call has a much higher theta component, a much higher time decay component, because, like we described earlier, 1 day of time movement in the 30-day option is a much larger percentage than 1 day of time movement in a year-and-a-half in a 550-day option.
Well, how about if we go back to that favorite XYZ stock, and we've got the long 85 LEAP? Tell me. Let's see. I guess we got the $100 stock. We're long the $85 LEAP call. What strike would you typically sell on a diagonal?
So I'd look to sell an out of the money option.
Okay.
Again, since you're only looking out maybe 30 days, it will be relatively close to at the money, maybe 5% out of the money. So right. in the XYZ example, XYZ trading 100, I'd probably look to the 105 call and see what kind of premium I got, what kind of delta I was selling, and what kind of implied volatility I was selling, and look to overwrite that 30-day call. So the benefit of this is obviously it'll be a small amount of premium, especially relative to your LEAP option that you've bought, but you want to look at that time value of the LEAP, or you want to look at the extrinsic value, which is also shown on the OptionsHouse option chain. And what you're trying to do is recoup some of that extra time value, that extrinsic value, that time value from your LEAP call by selling the 30-day option and continuing to roll that out as that 30-day option comes close to expiration.
I got you. So here we're talking about an option that's $15 in the money, but it's 15 months out. And so, potentially you've got $4, $5, $6 of premium, and you could, literally 15 times if you did this month over month, selling out a money call. Obviously, you have, you're capping your upside gain to a point, but you can always roll that as well. So the idea is to offset that time premium that accompanies the LEAP by selling these short-term out-of-the-money calls, right?
Absolutely. And now that shorter-term option is going to require a lot more maintenance, because
Sure.
because the shorter term option will have a higher gamma component. So its risk profile and its deltas and the different Greeks will change more dramatically with sudden price movements in the short term. So you do have to monitor that 30-day option, because if you just let it go and the stock rallies through your upside call that you're short, your opportunity cost will kick in, and you won't make any more money to the upside.
Gotcha. All right. So 3 different approaches: just buying the LEAP as a stock substitute, potentially doing a LEAP vertical call or put spread, depending on your forecast, or this LEAP diagonal where you're long the LEAP and selling front month out of the money options. Are 3 different LEAP strategies for investors, and I think that's it all makes a lot of sense, and I think you laid it out clearly. Thank you.
Excellent. I really do think that weeklies have really become a popular product, but I really think for a stock investor that is looking to expand his investment arsenal into options, I really think LEAP options are going to behave much more, normally it might be the wrong term, but much more as he is used to stock trading. And here's the key point with these LEAPs and key point with all option strategies. If you buy a LEAP option as a stock replacement strategy because you expect an appreciation in the stock, that would somewhat make sense, right? And so you buy the 85 call as a replacement instead of buying $100 worth of XYZ stock. And you, in fact, get what you targeted. You have your trade plan. You're saying, I think over the next 3-4 months, I think XYZ could rally 10%. I think their business looks good, for whatever reason. And you actually get that 10% move up in the stock. So now the stock is sitting at $110. Many traders new to options think that they need, because they have an expiration date, think that they need to hold these LEAP options, hold any option until expiration. That's absolutely not the case. The options market is this wonderful market now. It's got so many participants. It's very liquid, and we should talk about liquidity of these options a little bit as well as a consideration before entering into these trades. But if you hit your target, there's nothing wrong with you replaced your stock ownership with a LEAP option. You go ahead and sell that LEAP option out, and you've over the course of 3 months in a 1.5 year lifespan is 1, 2, 3, 4, 5, 6. It's 1/6 of its life is now gone. But go ahead and sell that out, and assuming that volatility has not changed a great deal, your return on a percentage basis is going to, I can't.
You're talking about taking it, but don't be afraid to take a profit.
Taking a profit.
Hey, there you go.
No one ever went broke. No one ever went broke taking a profit.
Amen. Amen. Well, are they your final words of wisdom, or do you have something else you'd like to add, or a war story before we wrap it up?
The other thing, one other word of wisdom is the management of that short option. Whenever you're short an option, folks, best mentor trader I ever had told me of my position. I used to get a little too attached to my position, right? And I'd sell an option, and I'd sell an option trying to make that premium, trying to make the 30-day premium on the short option. And then all of a sudden I'd come in and the option was trading at 6 cents. And he goes, "Why are you selling those options at 6 cents?" And I said, "I didn't sell them at 6 cents. I sold them for $1.50." He goes, "If you don't cover that short option today at 6 cents, it's the same as you selling it at 6 cents. Do you think the risk reward's right to sell that option at 6 cents today? If it's not, close it down and roll it out and put out another short option that actually has some reward and not just tiny amounts of reward, 6 cents of reward, and all risk to being short that option." And I do think that was wise advice back then, and it's still wise advice now.
I agree. Sounds like a mentor who may have been burned on a few short 6 cent options in the past.
Trying to make that last 6 cents of options is the most expensive proposition out there, I think.
Can be, indeed. All right. Well, Steve, great to talk to you today. Appreciate you taking the time and offering your expertise on the LEAPS strategies, and we look forward to talking to you soon.
Thanks, Joe. I really appreciate it. Thanks so much.
You're welcome. Bye-bye.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, I want to mention one of the lists in the Wall Street Journal I used to check almost daily and always when I thought the market might be entering a bottoming phase. The list I'm talking about is the new high and new lows lists. The size of these lists can act as a contrary indicator. The greater the new lows, potentially, the closer the market could be to a short-term bottom. So to get comfortable with how many new highs or lows suggest a turn may be near in the market, you've got to go back, do some checking at previous market highs and lows, and see if this list length is extreme, and you could potentially then consider, the length of this list as an indicator looking for a future market bottom or turning point. Now, for today's good read, I want to suggest an old classic, Reminiscences of a Stock Operator, first published in 1923. It's the fictionalized biography of speculator Jesse Livermore. What's so interesting about this old classic is that many of the methods and analyses of the markets dating back to the 20s still ring true today. That's it for today's Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back segment, we're going to change things up a little bit. We're happy to say that a number of our listeners have contacted us and asked particular questions coming out of some of the previous shows. So how about if we start with a question from Tom Scalen from White Plains, New York. Tom writes, I'm enjoying the new program on the Options Insider Radio Network. It provides an interesting overview of the options market and all its component parts. However, I'm somewhat new to the concept of clearing and how it works in options. What does it mean when you say that you cleared a contract? Since the host works for the Options Clearing Corporation, I hope he can answer my question. Thanks again, and keep up the good program. Well, thanks for that question, Tom. A contract is cleared when OCC receives details of a match trade and it steps in to become the central counterparty. That means OCC becomes the buyer to every seller and the seller to every buyer of an options contract, guaranteeing the obligations of the contract are fulfilled. Now, question 2 comes from Carlos Esposito. Carlos writes, can the host explain what is meant by the term dividend trade and how those trades impact overall option volume? Well, a dividend trade is an option trade when an investor buys a deep-in-the-money vertical spread. The options that are purchased in the spread are exercised, so the dividend is received. The hope is that the short option will not be assigned and therefore net the spread buyer the value of the dividend by the number of short contracts not assigned. And these dividend trades do generate fairly significant option volume. Our third question comes from Joseph P. Joseph states, great episode on mini options, but are there any plans to expand these products beyond the initial classes? Currently, Joe, there's no news about an expansion. I asked our guys down at the Investor Services Desk, and they mentioned that as is the case with any new listing or expanded pilots, they don't get a heads up unless it is in the filings from the SEC. So as of now, nothing new in terms of new mini options. And our last question today in looking back comes from Phil Fan. And Phil asks, any truth to the rumor that Joe is related to the Philly Fanatic? Philly Fanatic? Well, thanks for that, Phil. The only thing I can say is the only living relative of the Fanatic that I know about is his mom, Phoebe. The Fanatic's birthplace was the Galapagos Islands, and I don't know that I have any relatives down there in the Galapagos. But thanks for your question on the world's greatest mascot, Phil. And that's it for today's Looking Back. Please join us again for our next Wide World of Options.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.